The Canadian jobs market is breaking down, and it's happening a lot faster than most people realize. In this video, we're going behind the headlines to discuss the numbers that no one's really talking about. The largest job losses in years, unemployment climbing to multi-year highs, job vacancies collapsing, and AI quietly replacing careers that were once thought to be safe forever. Then I'm going to connect it all to real estate, using 55 years of historical data to demonstrate what happens to home prices when unemployment surges, why this time is different than anything we've seen in the past, and how it could be even more impactful than anything we've seen before. What I found genuinely shocked me, and I think you'll be surprised too. Let's dive in. Canada's most recent jobs report was a gut punch to the economy. In July alone, we lost over 41,000 jobs, the largest monthly drop in more than 3 years, blowing past every economist's worst case prediction. Even worse, the quality of jobs is falling apart. Full-time positions dropped by 51,000, almost entirely within the private sector. Looking back, the unemployment rate has been steadily increasing since it bottomed at 4.8% in July of 2022. Today, we're at 6.9%. The highest in 4 years, and there's currently no sign of it plateauing. The cracks run even deeper when we look at the employment rate for prime-aged Canadians, those between 25 and 54. It is now at a 26-year low outside of the pandemic, a level we have not seen dating back to 1999. For young Canadians, it's even more grim. Youth unemployment is running at 14.6%. The highest that metric has been in 15 years. And in Toronto, it's even worse. The unemployment rate there has hit 9.2%, the highest since 2010 outside of the pandemic, with youth unemployment in the city at a staggering 20.1%. That is 1 out of every 5 youth looking for work and just not able to find it. And what about those who have lost their job? Well, they're staying unemployed for much longer. Over 370,000 Canadians have been out of work for more than 27 weeks. That's over half a year. And it marks a 14-year high for long-term unemployment. When you put this all together, it paints a pretty eerie picture that says we are likely well into a recession already. With all that data being a current snapshot of where the unemployment landscape sits today, what are the economic drivers pointing to you as to where that future trend will head? Unfortunately, the forward-looking data does not provide much comfort. Private sector payrolls are down on an annual basis by the largest amount in a decade, a trend that has never happened outside of a recession. Looking to job vacancies now, they are essentially collapsing, down 9% in the last 3 months alone, and now sitting at just 2.7%. That means for every Canadian losing a job, there are fewer opportunities to find a new one. The math is pretty brutal. In May of 2025, Canada had 1.57 million unemployed people, but only 478,000 job vacancies. That's 3.3 unemployed Canadians for every available job. And that number is up from 2.0 just a year earlier, a whopping 65% increase in competition for jobs in just over the last 12 months. Even those with jobs today are feeling nervous. A recent survey shows that 20% of working Canadians believe they have a real chance of losing their job within the next 12 months. Think about that. That is a higher level of job loss anxiety than we experienced during the COVID lockdowns. When you couldn't go to work, people are more anxious about losing their job in today's landscape. Add on top of all of that, an even more recent threat, artificial intelligence. It's no longer an existential threat. It's actively eliminating jobs today. Positions that were once considered untouchable, like software developers, are among the first to be automated. In fact, estimates from Forbes and Goldman Sachs suggest as many as 30% of jobs could be at risk by the year 2030. For Canada, that would mean over 6 million positions. And sure, even if that's overly pessimistic, cut that number to 10% or even 5%, and we're still looking at hundreds of thousands of jobs disappearing. And this isn't just happening within a vacuum. It's hitting during a period where the economy is already under pressure, which is ultimately compounding the problem. Taking all of this, it's not really any surprise that the Consumer Confidence Index is now sitting at levels we haven't seen in over 20 years outside of the global financial crisis. Ultimately, when people don't trust the economy, they stop spending. They hoard cash, and that slowdown in spending causes more layoffs. basically creating a vicious feedback loop. So now let's connect all of this data and see how it correlates to housing prices. Understandably, there are many factors that influence home prices: interest rates, supply and demand, but unemployment is one of the most critical. Without a job, people simply can't qualify for mortgages. Without income, they can't keep paying the mortgage they already have. That forces some listings onto the market, often at discounted prices for a quick sale. Now, even though the landscape today is different than really any time in the past, one of the best predictors of future outcome is past performance. So let's do a comparison of unemployment rate versus housing prices. The amazing thing is we have 55 years of data to help us analyze this. Have a look. Okay, so here is Canada's unemployment rate dating all the way back to 1970. See, then we started around 4.5%, increased all the way until about 1983, where it hit as high as 13%. It trended down, spiked again, had a really nice run all the way through to 2008. Obviously, we know that was the global financial crisis. Spiked, trended down all the way to COVID. COVID did what it did, and now we saw that cycle low in 2022, and of course that 3-year run of increases bringing us to where we are today at 6.9%. So let's now compare historically what the unemployment rate has done to house prices. So this line here, this pink line, is the historical prices of Canadian homes during that exact same time frame dating back to 1970. Now, this is not adjusted for inflation, and I think it's going to be a little bit more impactful to actually share those numbers, right? So I'm going to swap this line out for this one. This red line here shows the real prices of Canadian real estate adjusted for inflation. As you can see, the swings are a bit more dramatic and will definitely help with this exercise further. You can immediately see there is unquestionably a correlation between a spike in unemployment and a decrease in home prices. I'm going to overlay some colors so that we can help see this even further. So these gray bars now illustrate when house prices went down, and then you look up to see how that correlates to what was happening in unemployment. Again, quite clear, right? Look at 77. There was pretty notable spike in unemployment, home prices decreased. Jump ahead to 82, a massive and very significant jump in unemployment. Home prices dipped dramatically there as well. It recovered, and then again, we get all the way up to 1990. Spike, unemployment, decrease in home prices, okay? Time and time again. So it's unquestionably, there is a correlation here. Again, bring it all the way up to 2008, global financial crisis, spike, unemployment, dramatic decrease in prices. So I think it's fair to also demonstrate how the opposite happens, right? When unemployment is decreasing, we see prices increase. So that is demonstrated by these green sections. You can tell when home prices are going up, typically we see employment rate improving, okay? 85, straight down line of unemployment, right? The unemployment rate was improving. More and more people had jobs, and that directly affected home prices going up. Jump ahead, of course, here to 1998, sort of the end of that downward cycle. Unemployment was improving. House prices had a decade here run up before unemployment spiked again and prices dipped. Going back to the price corrections now, what we see here and what I want to demonstrate further, because we're really getting into the meat of this now, is this line here. When we see unemployment within that band, that is when the most notable house price decreases happen. Okay, if we look over, pretty clear. Home prices start to decline at about the 7.5% or higher unemployment rate. So looking back over 55 years of Canadian data, there is this clear pattern. Once unemployment hits 7.5% or higher, home prices almost always trend down. In fact, the correlation is so strong, it's one of the most reliable predictors of price drops. But here's the kicker. Look to where we are today and the latest downtrend in housing prices that started in 2022. We have already had home prices trend down for 3 years, even while unemployment stayed within that sort of 5 to just over 5% range. That has basically never happened before outside of a very brief period here in 1974. And it certainly never happened for this long of a time period. If unemployment pushes into the 7 to 8% range, we're in dangerous territory. If it breaks above 8%, the pressure on housing could become severe. History tells us that in those conditions, forced sales rise sharply, buyer demand evaporates, and prices can fall quickly. The real difference that I'm seeing this time is that the market is already soft before we even get to those levels of unemployment. Inventory is high, sales are at like multi-decade lows, and affordability is already largely stretched to the limit. That means that any spike in unemployment now will hit a market that kind of doesn't really have a cushion to fall back on. If joblessness climbs while interest rates stay elevated, the combination could drive a wave of distress selling. This isn't just about a few percentage points off the top. It's about the potential for multi-year declines, following the ones we already experienced. We could quite realistically see some prices revisit pre-pandemic levels in some markets, and in the most overextended segments, probably even lower. The longer that unemployment runs high, the longer people are going to have to dip into their long-term savings, possibly running out of borrowing options and be forced to sell. We are ultimately in uncharted waters. We are seeing dramatically lowering prices before an unemployment spike. If unemployment continues to rise well into 2026, the impact on housing could be sharper and longer lasting than most Canadians are prepared for. For homeowners, that means reassessing risk and ensuring that you actually do have a plan B. In the end, this isn't about panic, it's about awareness. The job market and the housing market are extremely intertwined. And right now, both are flashing the same signal. Be ready for what's coming next. Thank you so much for watching. I really hope you found today's episode helpful. If you're curious about what this ever-changing market might mean to your property, or if there might actually be a good time to buy years down the road, feel free to reach out. I'd love to chat more and see if I could help. No pressure, no sales pitch, just an honest conversation, helping answer the questions that are important to you and your family. Feel free to reach out anytime. All my contact information is below. Thanks so much and have a great day.